Joining us now is Kane Brennan, CEO of TIFF Investment Management. You want me? Do I call that? I don't call that TIFF, do I? Kane, you want me to call it TIFF or TIFF?
TIFF is terrific. We serve foundations and endowments, and that's the acronym.
That's the acronym. Okay. You have I think in the back of your mind, more of a fiduciary responsibility. It's a fine line to try to maximize returns. You need to be in equities, but at the same time, do you kind of have maybe 1 foot out, or at least do an asset mix that might try to minimize being caught, I don't know, too exposed in one area?
Well, look, we've been serving endowments and foundations for 30 years. We recently polled them and we asked them, what do you think the chances that a 60-40 portfolio is going to meet their return target of, inflation plus 5? And roughly 60% of them said they have no chance. And that's because where equity starting valuations are today, as well as interest rates. And so it's hard to put a lot of feet out of the markets, as you asked about, because people need to take risk. It's just hard to get that return bogey. And it's never been harder. It's never been harder than it is today. So it's hard really to be fully out of the markets despite some risks out there.
Never been harder because rates are so low and as a result, valuations are high. And I think 10 years ago, I heard that they were going to be muted average returns per year. But you're trying even more muted for the next 10. 3% is what you're trying for.
I think so. After inflation, we think they're closer to 3. And so you're right. Equities have been reasonably valued for a long period of time. Call them today, 22, 23 times forward earnings. But interest rates used to be, 3 or 4%. And until about a month or two ago, they were 50 basis points. And so it's just really hard to get the level of returns that you need from market betas. What we tell our clients, first thing we do with our clients is we go through their portfolio and we go through their balance sheet and their income statement. We say, how much risk can you take? So we go client by client. And then once we figure that out, we tell them you should take as much risk as you can, point 1. And then secondly, you're still unlikely to get there with passive returns. You need active returns. And as a quick digression, this is a narrative we think the market gets completely wrong. Everyone says you can't outperform with active, you can't get excess returns. We think that is folly. We think you can get active returns, and we've been doing it for a long time.
So you're 40% Dogecoin? Did I read that? Is that maybe not? Maybe not. That's not. But some of these, here are the sectors where you say you're leaning into: China, Taiwan, emerging markets. You have to use hedge funds if you find the right ones, and I guess you need to do private investments as well to try to, and all that put together minimizes the amount of risk and maximizes your return, but still to a very, what looks like a fairly low goal.
Yeah, it used to be that fixed income basically did 2 things. One, it pulled its weight in terms of returns. And secondly, it acted as a negatively correlated asset whenever there was a big drawdown. Fixed income doesn't do either of those 2 things today. So we kind of split the problem in half. In the first half, we say, how are we going to get you a little bit of excess returns? We are looking at multiple places. One is, because we're worried about inflation, let's have less fixed income, which will be negatively impacted if we do get a lot of inflation. 2, let's look outside the U.S., particularly if the dollar is going to devalue. So some of the places you said, China, even Europe today, after 5 years of being underweight Europe, we finally closed that relative short. So let's look outside the U.S. Let's look at places that are going to benefit, like financials, like energy. But that's all trying to get you a little extra return. And you're right, hedge funds and private equity absolutely have a prominent role in that.
So you try to hedge dollar bets with what you said, but you would not do gold or Bitcoin or crypto.
A lot of our clients ask us about Bitcoin. It's probably the most frequent question in the last few months, a little less after the recent volatility. In our view, things like gold and Bitcoin, whether people know it or not, they're trying to find a replacement for fixed income. They're trying to find something that will be negatively correlated when equities go down. And we don't think either of those are a terrific substitution. Bitcoin, it is definitely not an equity hedge. For those that have said it's going to be a hedge and it's going to save your portfolio, down 30% in a couple hours does not fit our definition of a hedge.
Shepard Smith here. Thanks for watching CNBC on YouTube.